Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Serge Berger on the line. He's the head trader and investment strategist at the Steady Trader. Serge, good, long, relaxing weekend?
Yeah, not bad. It's autumn, so it's always I love this time of year.
Favorite time of the year. You can still wear shorts and 70 degrees and go to Michigan football games. I don't think you can ask for anything more.
Exactly.
All right, so you brought up a really good point here that I've failed to touch on during the whole show here, and it's the end of the third quarter. So there might be a little window dressing, a little window undressing, and you have experience in the markets, managing money and making things look good at quarter end here. What do you think? What are you going to look like for this end of the third quarter?
You know, I wonder how much it's going to be able to affect the markets and sort of overshadow any of the broader market fears that we have, right? I mean, the markets do feel very heavy. So I think like when it comes to quarter end, I have a very hard time always saying, oh, this is going to happen or that's going to happen, especially in this type of environment. But I will say this. If we look at stocks like Facebook and Netflix, right? So these guys are up like 7, 8, 9% quarter to date. The S&P is down 6%. So I would think all else being equal, and I guess that's the big X factor, there could be a potential bid in some of those stocks, right? At least from a window dressing perspective. Now, if that fails to happen, I would think the opposite could basically take place, and they just dump anything, right? Just to kind of raise some cash and take profits where they can. So it really could go either way. I'm looking at those stocks specifically: Facebook, Netflix, Tesla, a bit of an outlier because they have that new car coming out on tomorrow and Wednesday. So I would look towards those stocks that don't have a major news factor as well this week to see if they can catch a bid or not, and then play them in that direction.
So, do managers, like if they have this Facebook in here, do they want to buy more, show a big position in it? Or will they, like, whew, man, I got to offset some of these losses. I'm going to take some profits in Facebook. How do they approach it?
Well, that's the question, right? I mean, I guess I'll turn it back to you on that. I don't know. I mean, I had my weekly calls with all the hedge fund guys, and we didn't really know where people are leaning this quarter. They could lean either way because it's been such a bad quarter. It's been the worst quarter since 2011, the same quarter in that year, I think, and so it caught people flat-footed as it usually does, and volatility creeps up. And I don't know. I mean, what do you have it? Do you have an
Yeah, I
idea?
mean, if I had some big money on it, and I was managing a lot of money, and I had something like this in my portfolio, and I had some losses and other things. I mean, I don't think I'd buy more of this to say, oh,
Yeah.
look at my huge position. I would say, I don't know if you take profits in it or buy puts or sell calls in it or whatever, but I think you might what I'll be looking for is maybe to dress up your portfolio by, selling some of your winners and say, hey, we didn't take profits on everything. Oh, but we just took profits on Facebook here. And
Right.
as opposed to, missing a quarter and dropping down to $80 and then everybody, chasing it after that. So we'll just have to see. All right, moving on here to the financial sector. And we just got a lot of talk of whether or not interest rates are going up. We had the XL laugh at some of the financials run up ahead of the interest rate hike that was supposed to happen. They didn't get the hike. We went down. Mixed news out of Janet Yellen here is the financial sector kind of like a little safe haven here in this turbulent market.
So I continue to be very constructive on financials through a 6 to 12 month lens, but I'm not going to touch them right here. I think last time I was on, we talked about going short Bank of America and those kind of things. So my bigger picture here is I think it's really difficult right now to play rates, especially to buy these ETFs. And you can, I suppose you can just kind of keep long a little bit, like a TLT, like long bonds as opposed to long, rates. But I think it's really hard to trade this stuff right now because it's really choppy. And I think financials are basically in the same boat. But I'll say this, and I think this is to me kind of like the more important picture this morning. If you look at the past week and a half of trading, the S&P has now sold off both on a hawkish Janet,
There you go.
or well, like dovish Janet and a hawkish Janet. So she just can't. I think to me, And I don't want to do all like, doom and gloom, but they do seem to be a little bit out of bullets here. Even Dudley can't keep the markets up anymore. And and by Lord, he tries. He's got those well scheduled appearances on TV, and he just can't keep them up anymore.
It's funny that you mentioned that because at the beginning of the show, Dennis and I were doing the general market thought, and I said, this is just kind of a confused market because normally with interest rates going up, it's generally bad for the market because people could put their money in other assets besides the stock market. Not that you're going to get rich if, putting your money in CDs if interest rates go up a quarter point, but the Fed announcement, they were very mixed that they rallied it, and then they decided, no, it's bad that we're not raising interest rates. Then Thursday, you have your bad day, and Janet Yellen comes out hawkish, and I was just scratching my head on Friday, and I'm like, oh, so interest rates are going up, and they're rallying the S&P's 35 points, and
Yeah.
that had quickly given away here. I don't know if you look at biotechs much, but we have a new chatter in here. It looks like EJade is asking about the biotech sector. Bad news last week. I know Hillary Clinton was weighing in on it. I mean, this was the darling sector here. I mean, I just in good faith here. I mean, I'm looking at Friday's low, 304.56. We haven't hit that yet. The only thing between that, if you take that out, is the flash crash low here. That's way down
Right.
to 284.16. I mean, I've never played these stocks in my portfolio, never even the ETS because a lot of it's hit and miss. I mean, is this a potential sector to lead the market back to new all time highs?
I don't know, man. I mean, I actually did a fairly lengthy webinar on the IBB and trend following stuff this weekend. And we kind of took apart the IBB. And to me, this is really the first time now we've got a real threat at breaking that real long-term trend in IBB. We've had a few scares all along. But I think this time around, you can toss this into a logarithmic chart and do all sorts of funny things. But to me, this is now really looking like a potential trend break. Doesn't mean it's got to fall apart and go back to 200, but it does mean that a V-shaped reversal does increasingly look less likely. The kind of stuff we've been accustomed to for the past few years, and it honestly brings up a big of a broader point, and I think we've talked about it in the past. But I really think one of the biggest or concerns I have out there right now is, and I have this Twitter stream that's sort of like a contra stream, where basically the people that are always wrong are in one stream and my thing, and they're really good at contra indicator. And these are a lot of folks that have only been in the market for like the past 6 years, and they have this buy the dip mentality. And I honestly think it's a really dangerous thing because, and it's Fed induced to some extent, where literally every single dip, particularly in some of this trending stuff, has been bought. And these people don't know anything better. So they're going to buy the dip again. But at some point, it's going to stop working. And, you know, it's going to be ugly.
And that's a great point you make here, and I think Dennis and I talk about it a lot. Like, let's say Biogen here. All right. Wow. What a great looking monthly chart, right? If you zero in on the weeklies, it doesn't look so good. The dailies, it looks absolutely terrible. But the
Yeah, looks
monthlies,
like death.
they're people that are still sitting, on a couple 100% profit. They could have bought this thing from 2008 really through 2012. So 4 years of buying this thing around $100, doubles and then goes up even more. The thing is that what some of these buy the dippers have to realize is that some of the big money or bigger investors, they're in this at 120 or 130. If they say,
Right.
okay, if this goes under 281 again, that was a flash crash, I'm out. I'm just
Right.
out. Well, yeah, they might be selling at a theoretical loss because it's come down so much from the all-time high, but these people are still sitting on huge profits. Meanwhile, if you've been caught in this low run, the run up in 215 here, you're 2015. You're just praying for a pop to get out, and it's a
Yeah.
lot you talk about. Overhead supply. They're going to be the investors that have long-term profits in this. They're going to be looking to sell on a pop. And if they decide they want out, I mean, they're not going to care about your 100 shares of Biogen that you bought at 530.
They're not?
No.
Darn. No, but the thing is too, and because I think a lot of this we can link kind of to a bigger picture thing. So strong dollar, right? This morning over in London, Glencore is falling. I mean, the wheels are literally coming off on this thing, and that's a big deal. So Glencore, one of the issues is a rising dollar, right? So a rising dollar starts smacking all these different uh, these different asset classes around for the past now 14, 15 months. Now in October, it finally hitting equities. People are going to be taking profits, kind of going back to the quarter end stuff, which is they're going to start taking profits where they can. And you don't think they have some profits left to take over in biotech? That's one of the few areas they have profits, right? So that stuff has the potential. I'm not saying it's going to, but it has potential to really feed on itself and give a real good old washout.
What about these dividend stocks? I mean, Dennis and I were looking at them, and a lot of your top components in the S&P, your Apples, your Microsoft, ExxonMobil, J&J, GE, Wells Fargo. They have these tasty, 3% dividends. You're not
Mm.
going to get there in the bank. Is this just a value trap here? I mean, with interest rates, or you do have the principal protection, but how are you looking at these dividend stocks?
So I'm starting to look at this now, and obviously we're not very far into a correction, and for all I know, we could start ebbing out again near 1800, 1820-ish in the S&Ps. But the way I'm starting to look at it is more. I've been going back to the roots, and for me, roots isn't credit and bonds,
Mm-hmm.
because there's a lot of stuff now in bonds. So like a lot of stuff now to me leads me to look at bonds again. Volkswagen, that's an issue. Glencore, that's an issue. Huge debt. So I'm going to start looking at some of the bonds of these big dividend players, because if there's credit deterioration there, and I'm not saying there's going to be, then that yield that looks relatively attractive, like an ExxonMobil with a 4% yield or whatever, that's nice in absolute terms, but in relative terms, that might become to be an issue. It just brings me back to the 2007 2008 area when cheap got cheaper and higher yields, high yields became higher yields. So I have that's kind of my thing. Does that kind of make sense?
Yeah, it does. I mean, to me, it's just like too obvious that they're good buys.
Right.
It's just they're sitting there staring you in the face, and I just, I mean, I'm trying to, put some money to work here on the downside, and you think you do have that dividend protection, but a 3 or 4% move in some of these stocks, that could just be wiped out in a day, or.
It's a naked put. It's the payoff of a naked put, right?
Mhm.
I'm sorry, a covered call, right? So, and we all know how those covered call strategies they have. If you look at the historical covered call strategy P&L, if the true P&L curve of those strategies were ever pitched to your typical mutual fund investor, they wouldn't touch those things with a 20-foot pole ever, you know. And I think it's the same thing with dividend stocks. I mean, it's to me, it's almost like a short call selling strategy or net credit strategy, option strategy payoff. You have a lot of winners, and then there's one nasty loss, and it's just how it is. And it's the same thing with covered calls, except that covered calls and these dividend plays, it's because I don't think the people running these strategies really have a real don't know what really can happen to these stocks. The GE can fall apart just like any other stock can, and it has in the past, right?
With the covered calls, the good ones get called away, and then the
Right.
ones that like end up really dropping. Well, oh wow, I got the buck and a quarter premium that I
Yeah.
sold in the call, but now it's $4 lower. So it.
But you know what the real sad is about this? This real sad thing about this, Joel, is I talk to, and the hedgies get it because they're a little bit more momentum driven, at least the ones I talk to. But I talk to a lot of guys like big dudes at like private banks, and all they do is talk about these covered call strategies and dividend stocks, and I'm just like, guys, that's gonna work, and it might work, but one day you're just gonna sit there, buck naked, because you're gonna get stripped of all your entire call and credit and yield stuff that you had going on for the past 5 years. It's gonna take a week for the market to wipe all that out.
And the other thing too, and you think, okay, I'll be tricky, I'll buy puts, but you're going to be paying up for the premium in the puts. And
Right.
the longer you go out, so you don't know if you're going to have the premium on at the time that you really need it. Let's just take a look at the market here, and boy, oh boy, that Apple news just provided a great shorting opportunity here
Yep.
for the entire market. They popped this thing over 115, got a green on the day. No such luck here. We are now trading down in the S&Ps. We are approaching that pre-market low of 0.2 and a quarter here. So Apple not providing a bounce to the market. I know you've been active in Apple both on the long side and the short side. I mean, you're looking at this chart here and you're thinking, wow, if the market's really going to hell in a handbasket here, then
Mhm.
what am I doing long here, Apple at 114? Not only what am I being long it, why don't I get short this thing? I mean, what's your thoughts on Apple?
I personally am in the same camp I was last week on Apple, which is more or less it's choppy unless you're day trading it, right? But I think there's a nice range. Now, if you can get short the stock by all means, um, to me it's more of a proxy to at least the Nasdaq 100 or the Nasdaq,
Mm-hmm.
considering the heavy weight and the Nasdaq Composite and the QQQs. They had a horrendous outside day on Friday. So yes, I think we can get a short. The 50 days holding as resistance again, last Friday. So maybe that's something to play against. By the way, Facebook is snapping that 50-day like it's its job down 2%. So none of these things are holding up.
I think these managers were listening to us, like, I gotta get out of this Facebook here. I gotta show some winners.
Yeah.
What about the gold? What about gold here? Supposed to be a safe haven when the market's down 130 points. You don't expect to see gold down 15 bucks.
Mm.
Trading range. Do you have a spot where you like it, where you don't like it? What's your outlook on gold?
I wonder, I wonder if the gold hasn't been isn't today down a little bit on that whole Glencore news.
Could you go
Copper's
into
getting
Glencore a
smacked.
little bit?
And I'm not, and I'm always hesitant to say a stock is going to lead a commodity, which it doesn't. But in this case, Glencore's a big deal.
Could you go into
And
that a little bit, Serge? Because I don't.
I'm sorry.
Could you go into Glencore? What
Sure.
it is and what the implications are. I think you got
Yeah.
a
So
little bit
Glencore
more
is
information.
basically a massive mining trading company. Like they mine and they trade, and it's basically a crazy hedge fund, very complicated shop. And and essentially the problem is that this morning the stock's down 25% over in London, and and it's just stuff is snowballing. So these guys have heavy commodity exposure, right? So copper is down 50% since 2011, 50%. You know, gold is probably at this point just kind of tacking out on the back of that. It's just not helping. It's not helping sentiment. So I think people are getting. And by the way, Glencore was one of those like hot IPOs of whenever they went out, I think last year or the year before. I want to say it was last year they had their IPO in London. I mean, it was just every analyst had a positive spin on it, and now it's it's at risk of wiping out investors.
Yeah, I know these commodity funds here. I hate to look at my next statement in one of these, but you got to put the money to work somewhere. China. I mean, don't I think we have don't we have their president coming over here for a meeting?
Well, he
As
is
a,
over. He is
he is
over. I just
over.
don't know where. Has he met the president yet?
President must be busy. He had the Pope in last week, and now he has a president of China in this week here. Are you putting any money in China? Well, you could just look at the FXI here. Terrible PMI numbers out of that out of China last week. Not good. This is going to flow over into our market.
I would prefer to start buying this stuff once it can start acting a little bit more mature. And then when I mean mature from a price perspective, I don't. To me, the problem with China is I don't have a real read on it. It's just we talked about this last time or a couple of weeks ago. I like to have a little bit of visibility, and I just don't. And it's not, I'm not even saying it's bad. For me personally, I can't gauge it. It's really hard. So do I want to buy something like that right now? Not really. Chart wise, it looks about as good as the S&P, which is somewhere between awful and horrendous. And I don't know. I mean, are you stepping in?
No, I mean, I just don't. I mean, the transparency over there. I mean, maybe some short-term pops or drops or something
Yeah,
like
for
that.
sure.
But
Yeah. Yeah.
I mean, it's a whole large cash position and just trying to figure out where to put it to work. And it doesn't seem like it's like China. It doesn't seem like it's dividend-paying stocks. I'm not that thrilled about the financials. The auto companies. I mean, with that news with Volkswagen. I mean, of course, the U.S. has stricter emission standards than overseas. So who knows how widespread the problem is? But it just doesn't seem like there's any safe havens out there.
I would say. I mean, and Safe Haven obviously would be a strong word for me when I use Tesla. But Tesla, there's something there. And for one, it's one of the few believable growth stories out there that the public's aware of. They got a new car, being showcased, and I guess it's Tuesday night, I think, over in California. Then it's basically the anti-Volkswagen, right? Unless they somehow actually do have emissions, the Teslas, which is
Right.
hard to believe.
They
But if
can't get in trouble with
then
that, right?
right. It's hard to get in trouble with that. So, you know, look, is that going to get this stock back up to 280 in this tape? Probably not. But it may be something to reconsider in a relative value play. Maybe you want to be short the autos for a trade versus a Tesla. It's just a trade idea.
We were talking about this with Scott Redler, and boy, you would have had to been quick on it. But if you get a chance later, Serge, take a look at the 256 area here. Holy smokes! Friday's low
Mm-hmm.
56.15. You had Thursday's low 56.21, and then you had a couple lows the prior week at 55.80 and 55.87. Someone has a huge opinion here at 256 here, so that's a key level. I'm not touching on a short side until we take that out. All right, Serge. Just any final words here? We just talked about just about everything. We talked about window dressing at the end of the quarter. We've talked the Fed. We've talked the financials here. Just final words of advice for traders slash investors.
I would just be cautious. We have the end of the quarter. We're coming into October, which tends to be fairly volatile, spooky. And so I wouldn't really step in here and blindly buy things. That continues to be my mantra since August, because I think that sell-off was quite telling. So be cautious, play from the short side if you're quick enough. Otherwise, look to buy them lower.
Okay. All right. Serge Berger, head trader and investment strategist at the Steady Trader. He joins us every Monday. Comes in to give us a great look on the market. We've covered a lot of things here, and I hope you snuck out of some Alcoa on that pop to 987.
Thanks, Joel.
All right. We'll talk to you again, Serge. Talk to
Have
you
a good
again.
week. Bye.
Thank you.